Hello, good morning. I am Avnish Jain. Welcome to this monthly debt outlook from Canara Robeco. Last month has been all about the US-Israel-Iran war. To recollect, US and Israel attacked Iran on 28th of February and the war continues unabated the last 1 month, more than 1 month. The US administration has been giving conflicting signals in the past few weeks. At one stage, US President did talk about getting out of the war, but again, in the next stage, they come back and talk about bombing another part of Iran, specifically energy assets, power plants. Iran also responded in kind, not only attacking US assets, but also attacking neighboring countries like Saudi Arabia, Qatar, UAE, Kuwait. This has led to the new paradigm shift in war, where the defender is not only defending himself, but also attacking neighboring countries without provocation. One major problem in the world energy market has come in form of Iran blockading the Strait of Hormuz. Strait of Hormuz is used by ships collecting oil, transporting oil from Middle Eastern countries to rest of the world. As per estimates, almost 20% of world oil flows through the Strait of Hormuz. Iran now has stopped ships going through Strait of Hormuz by threatening to blow up any vessels which try to cross the strait. This has led to a large shortage of LPG and oil for countries specifically in Asia like India and China. India has been negotiating with Iran for safe passage of their tankers, and few tankers have been received through the Strait of Hormuz in the past few weeks. But situation remains grim for oil prices. Oil prices have gone over $100 per barrel. Before war, they were around $70 to $75 range per barrel. In between, we did see some escalation where oil touched almost $120 to the barrel. This has led to large spread increase in prices across the world, specifically energy prices. Some countries like Indonesia and Malaysia have also instituted some rationing of oil because of shortage of crude flowing through, which has stopped flowing through the Strait of Hormuz. The impact of markets have been pretty volatile. The market has been dancing to the tunes of what President says on everyday basis. In a recent speech about 2 days back, President said that they were planning to probably stay for 2-3 more weeks before leaving Iran. And they were not really looking to open the Strait of Hormuz. However, in a most recent speech to the nation, to the US nation, he said they will continue to push forward with their objectives of totally obliterating Iran's offensive capabilities and also open the Strait of Hormuz. This wild swing between rhetoric by the US president has led to sharp movements in all markets. Indian rupee has felt the most impact of this crisis as India imports almost 60 to 70% of crude oil from other countries. The Middle East countries are the big supplier of Indian crude, and the partial closure of Strait of Hormuz has led to large shortages and also the prices spiking. Due to the closure of Strait of Hormuz, US had allowed India to buy Russian oil, and to that extent we have been able to get oil into the country and there has been no major shortages. However, the pricing has gone through the roof. As per media reports, India is paying over $150 per barrel for crude coming now, compared to over around $75 to $80 a barrel before the crisis. Clearly, the impact on finances of government and companies will be greatly impacted. Recently, government cut excise duties by 10 rupees across petrol and diesel to prevent oil marketing companies from having excess losses. As of now, government has not passed the oil price increase to consumers, specifically on the petrol and diesel side. There has been sharp increase in ATF or aviation turbine fuel prices, which has led to increase in airfares across local as well as global markets. LPG prices have also been increased, and due to shortage of LPG, there has been large lines across various LPG cylinder outlets, which we have seen in the past few weeks. As per reports, commercial businesses also have suffered because of shortage of LPG, because 90% of LPG comes from Qatar, which has been blockaded by Iran. India, of course, is trying to get supplies from other countries, and hopefully in few months they should be able to secure a larger amount of supplies from alternate sources. The impact on market, as discussed, has been pretty volatile. The rate markets have also suffered with other markets. If we look at US markets, the US 10-year yield has climbed to around 4.40 and is fluctuating depending on the rhetoric coming from US administration between around 420 to 440%. Indian yields have seen one-way up movement. Before the crisis, yields were around 6.70 to 6.75. In the last 1 month, the yields have climbed to almost 7% and now have crossed 7% in the past few days. This has been a one-way movement with no respite, despite RBI doing a large amount of OMOs in February and March of 26. Going forward, the rate market is likely to remain volatile as the situation remains pretty fluid. While US has been saying that they are likely to finish the war in next 2 to 3 weeks, the timeline gets extended now and then. If the war continues for a prolonged period of time, inflationary impact may be large. Till now, some of the central banks, specifically the US Federal Reserve, noted that supply shocks will not impact their rate trajectory. They are still looking at about a 25 basis rate cut in 2026. However, the market is not looking for a rate cut in US, but probably now trying to price in a rate hike, considering that oil prices have gone so high and may finally seep into secondary articles and core inflation. In India also, RBI will have to look at various factors, including impact of oil prices on inflation. Government had till now not passed on the oil price increase to the retail investor via keeping petrol and diesel price constant. However, we may see increase in petrol and diesel sometime soon. Considering this, the RBI may choose to look through these supply shocks in the short term. But if situation remains grim for a longer period of time, RBI may have to take action to control any inflationary surge. Currently, RBI has taken a number of administrative measures to support the rupee. They have cut positions where speculative leverage may be used by banks and other authorized dealers to speculate on rupee movement. This has led to appreciation of currency in the past few days. So we may see continued action by RBI to support markets, specifically trying to prevent sharp depreciation of rupee, considering the global situation. Rate markets may continue to remain volatile. Going forward, we may see rates going still higher, but at some point RBI may come in to give a signal that yields have moved to much higher. On the short-term, yields continue to remain low. This is due to good liquidity in the system, and in April we do see large amount of liquidity comes in. Short-term rate will continue to remain on the lower side because repo is at 5.25 still and liquidity remains good. Considering this situation, investors may choose to invest in money market funds or short duration funds, as these funds have typically comparatively lower interest rate risk. As well, yields tend to be higher on these funds as they primarily invest in money market papers and corporate bonds, which trade at a good spread over government securities. As always, investors should look at their investment horizon and their risk appetite before investing in debt. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.